As of July 23, 2026, after the closing bell, Tesla stock sits at $324.05 per share, down 1.30% during regular market hours, followed by an additional drop of over 4% in extended trading after releasing its second quarter earnings report. The immediate takeaway from this latest move is not just a standard earnings miss, it is the fundamental friction between Wall Street's immediate expectations for profit margins and management's aggressive shift toward heavy capital expenditure. While the broader consensus entered the day watching for automobile gross margin expansion, the real story quietly unfolding in the numbers is a massive pivot into artificial intelligence compute, energy grid expansion, and autonomous fleet manufacturing. The market wanted cash flow preservation, but it received an aggressive build-out phase. The prevailing narrative surrounding Tesla stock often switches between two extreme ideas. On one side, retail sentiment views it as an unstoppable technological monolith, bound to dominate full self-driving, robotics, and energy infrastructure instantly. On the other side, traditional equity analysts continue to frame it strictly as an automotive manufacturer, facing global EV price wars, high interest rates, and shrinking profit margins. Both perspectives miss the actual tension driving current institutional price action. The reality is that Tesla stock currently operates as a hybrid entity, a high-margin automotive business carrying the financial weight of an enterprise software and robotics lab, funded directly by its own balance sheet rather than external capital raises. Looking closely at recent trading volume and intraday price dynamics, institutional investors have been actively rebalancing their positions across major platforms like Fidelity Investments, Interactive Brokers, and SoFi Invest. For retail traders managing accounts on the Robinhood app or using self-investing strategies through Schwab Intelligent Portfolios, the elevated volatility in Tesla stock presents a continuous debate. The recent volume spike following the Q2 results showed high institutional participation, with block trades accelerating as the stock broke through key support levels. This was driven by a clear divergence. Second quarter revenue actually surpassed expectations at $28.24 billion, a 26% year-over-year increase, yet adjusted earnings per share came in at 33 cents, well below the 53 cents forecast by Wall Street analysts. That margin squeeze occurred because research and development expenses expanded rapidly alongside capital investments in compute clusters and next-generation vehicle production lines. When a company ramps up R&D to lay the foundation for autonomous transport networks, short-term earnings metrics naturally take a hit. However, algorithms operating on platforms like Interactive Brokers stock trading automatically trigger sell orders based on short-term EPS misses, creating rapid downward pressure regardless of top-line expansion. To fully understand where Tesla stock is headed, we have to look past the surface-level panic and break down what the company actually builds and sells. Founded in 2003, Tesla initially established its presence by proving that electric vehicles could match and exceed the performance of traditional internal combustion engines. Over time, its core vehicle lineup, led by the Model 3 sedan and Model Y crossover, became global high-volume products. Beyond the passenger vehicle division, which includes the Cybertruck and Semi, the company operates an expanding energy generation and storage business. This energy segment includes utility-scale Megapack systems and residential Powerwall units, which generated $3.14 billion in revenue in the latest quarter alone, growing 13% year-over-year. Additionally, the company is building out software revenue streams, primarily through subscription access to full self-driving, supervised, which has now grown to roughly 1.5 million active subscribers globally. If you are following Tesla stock closely through your individual brokerage account or tracking Fidelity ETFs, comment below how many shares of Tesla stock you currently hold or if you are waiting for a deeper pullback before buying. When analyzing the tension between market expectation and operational reality, macro factors play an equally large role. Global EV adoption rates faced severe drag throughout the past year due to high borrowing costs and changing regulatory subsidies across North America and Europe. Yet delivery numbers rebounded to 480,216 units in Q2, beating consensus estimates and confirming that consumer demand remains resilient when financing incentives, like reduced APR offers, are deployed. But maintaining volume through price adjustments or promotional financing directly impact automotive gross margins. This is the exact trade-off institutional investors analyze on Interactive Brokers platform or Robinhood stock trading. Do you sacrifice per-unit profitability today to secure long-term market share and software user density for tomorrow? Looking at the future outlook, several key catalysts will dictate the next major trend for Tesla stock. First is the production ramp of purpose-built autonomous vehicles, including the Cybercab and the commercial rollout of the Tesla Semi. Second is the expansion of autonomous rideshare services into additional metropolitan regions, which tests both regulatory approval frameworks and software reliability at scale. Third is the scaling of hardware for the Optimus humanoid robot, where initial production steps are slated to begin late this year. Each of these initiatives requires substantial capital expenditure, meaning operating margins may remain under pressure in the near term even as total revenue expands. The disconnect in Tesla stock stems from a fundamental mismatch in time horizons. Investors focused on immediate quarterly performance see an automobile manufacturer facing compressed margins and rising R&D costs. Investors taking a multi-year perspective see an industrial and software entity reallocating capital into physical compute, energy infrastructure, and autonomous networks. Whether you trade through Fidelity Brokerage, manage positions via SoFi Active Investing, or hold long-term investments in a Fidelity IRA's account, navigating Tesla stock requires evaluating whether management can successfully convert this heavy investment cycle into high-margin, recurring software and fleet revenues before market patience wears thin.